Welcome to another episode of the Capital Playbook. We are so pleased to have you today. We're excited to bring you some information that I'm sure you're going to benefit from. Today, we're with Mr. Byron Boston. He is with Dynex Capital. Now, what's interesting about them is that they are a REIT, a real estate investment trust company. So we get to learn a little bit about how REITs play in the secondary market and also on the primary market. But before we get started on our conversation today, we do have a couple of housekeeping things. Number one, if you like our episodes, please show us that you like it by hitting that like button and then subscribe and share the content. We certainly want as many people as possible to view our podcast. It's growing. We have a regular viewership in that 7,000 to 10,000 range, and we have over 250,000 cumulative views. So thank you for showing support for our podcast. And when you do that, it allows us to bring in guests like Mr. Boston, which we can talk about some things that it's hard to find out about or learn about on the streets. Again, join me in welcoming Mr. Byron Boston.
Thank you so much for having me.
Well, thanks for being with us. So, it's not often that we have an opportunity to talk to someone who's a player on the secondary market in the finance. But before we get into that, tell us a little bit about you. How did you get started in finance, commercial real estate? How did that journey begin?
So I appreciate you having me, and I appreciate the first question. It's been a fascinating journey. So I will say that. I grew up in St. Louis, Missouri.
Okay.
And I was recruited to play football for Dartmouth College. So I left home, and I brought up the football just to say that lured me to go far away from home. So I went to Dartmouth College on the East Coast, and I eventually found my way to economics. And I really enjoyed economics as an undergrad. I'm 63. I still enjoy economics today.
Wow.
So I'm an economics nerd, and I studied economics. I was kind of coached to go into finance by a group of alumni in St. Louis, Missouri, alumni of Dartmouth College. And they directed me to Wall Street, New York, get a job at a large commercial bank, which we call money center banks at that time. And I got a job in 1981 with Chemical Bank. That was one of the better bank training programs. So I was trained very well in a very disciplined, solid credit training program, corporate lending. I spent 3 years as a corporate banker. And then that was 1981 when I graduated, 3 years as a banker. 1984, chose to go back to graduate school at the University of Chicago, studied finance and accounting. And I took a little twist on my career, and I came back to Wall Street as a bond trader. And I joined First Boston, which was eventually purchased by Credit Suisse. And it had one of the better mortgage-backed securities trading desks. And I learned how I cut my teeth there on that desk. Larry Fink, who started BlackRock, was the head of that group. It was a strong, talented group of traders for me to learn from. So I feel very blessed that I had that opportunity. So I spent multiple years on Wall Street as a bond trader, mortgage-backed securities. I eventually went to Freddie Mac in 1997, and that's what we would call moving from the sell side of the street to the buy side. And it was also great because that's where the bulk of securitization in this country takes place.
Right.
They set the rules, they create the securities. I got an opportunity to really look below the actual securities that I was actually trading for years. Spent 7 years at Freddie Mac in their mortgage portfolio. Left in 2003. In January 2004, I started a company, a mortgage REIT. And we did an IPO in March of 2004 on the New York Stock Exchange. It was a successful IPO. We really operated for about 3 years. We got a takeover bid. We sold the company in October of 2006. And one of the things in life that I'm happiest about is that there were a nice group of shareholders that were part of my first company, Sunset Financial, who asked me to come help them rebuild this other REIT, Dynex Capital, which at the time, in 2008, Dynex, I would call a relatively dormant public company at that time. So I joined in January of 2008. I would call it a turnaround. I wrote a new comprehensive business plan for the company, and we began to execute to grow that company at that time. So since January 2008 till today, I've been rebuilding and growing Dynex Capital.
Wow, very interesting. What an interesting career. Now, you said that you were recruited to play football to Dartmouth College.
Correct.
Who's not known for their football.
They were then.
Were they then?
And they are now. It's always had a strong football program.
But
Absolutely.
It's also had a very strong academic program.
Absolutely. We're all scholar athletes.
Absolutely.
Yeah, that's exactly correct. We're all scholar. I am a proud scholar athlete.
Right.
I mean, I like to say, I like to win in the classroom and I like to win on the field.
Well, there you go. Well, that was the point that I was making. You had to be pretty sharp to get recruited by Dartmouth College.
Right. That's correct.
Because I don't think they're in the business of recruiting folks that don't tend to graduate, right?
Well, that's absolutely correct. And it's interesting. They didn't come to my neighborhood regularly,
right?
But I had a great high school coach,
right,
who really felt that I should go to an academic college, and he pushed me to go to an academic college. He ensured that I got recruited by not only the football college, the big powerhouses, but also really academic schools. And he really just, I don't want to say forced me to go, but he really was a major reason for me to choose to go to a Dartmouth, because I knew nothing about the Ivy League, knew nothing about New Hampshire. I grew up in the inner city of St. Louis.
Right.
It was Siberia for me to go to New Hampshire. So it was a great awakening moment.
Right.
I stepped out of my comfort zone, and I've not been afraid to step out of my comfort zone since, because I learned how to do it at that time.
There you go. Yeah. Well, perfect. Well, as I mentioned before, this is an interesting conversation, because oftentimes when we are interviewing guests on our show, they're more active, especially if they're in the capital markets. They're more likely to be on the primary side of the capital markets. Now, and if you don't remember, if you haven't been through our school or any of that, the primary market is where securities are created for sale for the first time. So an example would be, I take out a loan. I'm going to get, that loan is going to be secured or documented by a piece of paper. Okay, that's a promissory note. And that promissory note has certain terms and conditions, and it has cash flow associated with it. And so therefore that piece of paper can be sold to someone for value. And who we sell that to, it's going to be sold on the secondary market to someone like Dynex. So let's talk a little bit about, as a REIT, your role. Now your REIT was special in that you could be a REIT who played on the primary market only, owning assets.
That's correct.
Owning or originating those notes.
Loans. That's correct.
Those loans. Or you could be on the secondary side, where you're creating liquidity to purchase those notes, or liquidity to perhaps even trade the actual asset. Or you could do both. Okay, and you guys have done both. So tell me how Dynex performed on the primary market. What was your role at that particular time?
So the history of Dynex, really, we were about 32 years old, and we went public in 1988, New York Stock Exchange. First 10 years of Dynex Capital's life, Dynex was making direct loans. Okay. They were making direct loans to residential homeowners. They were making direct loans in the commercial market against a variety of product types, multifamily, office buildings, and a variety of other storage facilities. And Dynex would make those loans. They would then create non-agency securities, and they would fund those loans by selling these securities. They would sell debt to fund those loans. So the left side of the balance sheet would have a loan sitting there. The right side of the balance sheet would have debt that they have created to finance those loans, and then they would keep a slice of that securitization. Right. That's correct. So call that the first 10 years of Dynex's life. The middle 10 years was more of there was a long-term capital liquidity squeeze. Dynex was one of the companies that had to delever at that time. So consider a decade of deleveraging and consolidation within the company. I joined in January of 2008. We all understand what was happening during the great financial crisis. I was very well aware of that. And we chose to rebuild the company, emphasizing liquidity and securities. So loans are less liquid than securities. If you were to look at our quarterly conference investor package, every quarter we put out a chart showing you what we call the capital stack, the lowest credit, the lowest credit asset, all the way up to the highest credit quality asset, which will also have aligned for liquidity. So a whole loan or loan, direct loan, is the least liquid asset that we generally would invest in or that we would create. So today, starting in January of 2008, we've emphasized securities. And those securities over time have had a variety of ratings over the last 14 years or so. So yes, I always like to use my hands, left hand and right hand. The entire housing or real estate finance system starts on my right hand where there's savers, because that's where the cash comes from. Right. And on the left hand, there are borrowers, whether they happen to be residential or commercial borrowers. Very important to understand where does the dollar bill start? It starts with the saver. Right. At Dynex Capital, we consider the saver the most important person. That's the person who buys our stock. That means we now have the liquidity to take and invest and move that money, what I would call it, all the way back to the primary market where we'll buy securities. But the dollar starts with the saver. It's his money. Right. And then we have a borrower who gets the saver's dollars. What does the saver want? He wants his money back. Right. And he wants a return on his money. He wants the money to have kids. Yeah, that's exactly, I love it. Right. That's exactly correct. Send it off and come back with some babies. Okay, so and thank you. It's a very, very excellent way of explaining that. So now, as being on that secondary market, and you're basically supporting those savers, you're taking their money, putting it to work, you're creating value for them. You go out into this vast world where there are all types of securities you can buy. Right. I could create a security and, just note, and I made a loan on something and just call you up and say, hey, you want to buy this? Right. The likelihood of that happening is probably not, right? No. We're going to put you through a lot of scrutiny. Right. So because you're protecting the investment. That's exactly right. You're protecting that dollar of your investors. You're going to be very careful about the type of securities you're buying. That's correct. So as you, in your evaluation, what is your business model now in terms of evaluating securities and where you're buying those securities from? So we've got a broad opportunity set because we could invest in loans. Right. We could invest in the highest quality. And that's what I would call the bookends. The loan being the least liquid, Freddie Mac, Fannie Mae, Ginnie Mae security would be the highest credit quality. And just to explain something to our audience, because this is very important. Yep. You're measuring credit quality, and the highest credit quality, you often have used the term the most liquid. Yes. Explain why that's the most liquid. There's more of them. Right, it's more of them, and they're highly tradable. And they're highly tradable. Right. More people trading them. More investors accepting them. Right. And then in my world of trading, the bid-ask spread is much narrower than you would find if you tried to just go out and trade a individual loan. Right. Right. And so the other reason they're more liquid is you pool multiple loans together and you create a pool, which means that it's larger, right? And that creates more liquidity, right? Because you'll get more investors interested in that asset. So there's in the world of investing, there's more cash to be invested at the least, at the most liquid, most highest credit quality asset, and beyond Freddie Mac, Fannie Mae. 30-year security, you then move into the Treasury, the obligations of direct obligation of the United States government, now a sovereign debt. So as you create value by purchasing these pool of high quality assets or these high quality securities, how do you create yield? Because of the fact, one of the things you just mentioned is the bid-ask spread is small. It's narrow. Yes. Right, that's correct. So that means that profit potential is pretty narrow too. Yes. Right. But at your and I wouldn't say narrow. I would say narrower than the lower credit quality assets. But every now and then, or not every now, throughout any given year, macro events happen, markets move, and the relative value of the most liquid versus the least liquid will change. And it is our job to understand and to capture that. And so we make relative value decisions. Where's the best value for our shareholders, for us to deploy the capital? Gotcha. Is it really at the top of the what we call the top of the capital stack, or the most highly high credit quality more liquidity or is it lower?
Right.
And we, over my 14 years at Dynex Capital, we varied. We've gone down in credit and liquidity, and we've come back up in credit and liquidity. And we've done it for very disciplined, methodical, analytical reasons based on our macroeconomic view.
And really, that was the point that I was getting to, because one of the things you were mentioning, you guys have done really well at creating yield, even though you're dealing with these highly tradable securities. But you couple that with your knowledge of what's happening in the market and how the changing conditions in the market may create opportunities for you.
That's correct. And what I didn't answer fully is when you asked about creating yield, we do use leverage,
Right.
or we borrow money to increase the amount of assets that we can hold.
Right.
And so by doing that, let's say we have a 200 basis point or 2% spread, we could just take our capital and you buy it one time, you've got 2%. But then if you borrow another 4 or 5 or 6 or 7 times, you're increasing the overall yield to the ultimate investor. We have strong values at Dynex Capital.
Right.
So when I talk about, you use the word create value, we want to create value for both the investor and ultimately the borrower.
Right.
First, whose money? It's the investor's money. So
Right.
we want to make sure they get their money back. We want to ensure that if there are borrowers who need to borrow money, whether it's for a home or whether it's for a multifamily apartment building, whether it's for a mall in a community, we believe that we are contributing to America,
Right.
because we are financing communities across America. So we believe we're strengthening the communities in which we serve in 2 ways: by first taking care of the savers, and then number 2,
Making sure that
allocating.
there's liquidity
That's
in the
exactly
market.
correct.
And that's really important. So individuals sometimes don't understand when you go to get that mortgage, there has to be someone who funds the mortgage provider. In other words, who's going to sometimes purchase that security that has just been created. And that's what Dynex does.
That's correct.
They create that liquidity in the secondary market by serving the savers, which creates liquidity. But by being, I guess I can't think of the word, but by being good stewards of that capital, good stewards of that capital, making sure it's available so that they can loan to folks like us, where we go to get our mortgage, or if we want to buy or use credit in some way. Now, the market has changed a little bit recently, right?
Quite a bit, and still changing.
Still changing. And so now with the firm that's been around as long as yours, how do you evaluate the changing market? And then what do some of the changes that are happening now, how does that impact you and your business model?
So when we approach the markets, I've got my athletic background. I was trained by a great high school coach. I'm very disciplined about how I approach it. So I think of fundamentals, technicals, and psychology. And over again, I'm going to evaluate the market in a very disciplined, what we call top-down approach.
Right.
We're going to form a global macroeconomic view. We'll assess the fundamentals of the market and what we call the technicals. In effect, who's buying? Who's selling? Are the sellers larger than the buyers? Is there such as, what are the central banks buying? What are the banks buying? What are money managers buying? Are they buying? Are they selling? Are they adjusting from one product to another? So that would fall into the bucket of the technicals. And then it's the psychology. So if you think about what has happened recently, it's a great example. What has happened? What has really changed since last November? Well, the psychology of the government, central bank officials has changed. That then has changed the psychology of the market. In reality, the central bank is still buying bonds, but the market is trading as if they're going to stop buying bonds because their psychology changed, and they made it very clear to all of us that they are concerned about inflation. They're concerned about the size of their balance sheet owning mortgage-backed securities. So fundamentals, technical, psychology, very disciplined. Every day I'm going to sit down and I'm going to look at the market and try and assess where do I stand from that perspective. I love economics, as I said, as an undergrad, economics nerd. I've put a lot of time for my team in assessing global economics. Demographics come into play. a lot of data comes into play to understand what risks do we want to take. Ultimately, we have a global macroeconomic view, work our way down to the individual sector. As I said, I could choose to buy the most liquid assets, such as a Freddie Fannie 30-year backed by residential loans, or we can do what we did back in 2009, 10, 11, 12, where we went down to triple B CMBS, or commercial mortgage-backed security product, and triple B, single A, double A product, less liquid. We also invested in one loan fund at that time. We invested in some unrated securities because they were new products at the time that all phenomenal returns. So the risk return reward at that time, 2009, 10, 11, 12, because there had been so much disruption, really favored the less liquid products. At some point, the technicals got to where there was so much cash, especially as the central bank started to increase the size of their balance sheet, there was so much cash trading, chasing the illiquid assets that we found the return, the risk reward better being up in credit in the less liquid, in the more liquid assets with the better credit quality.
Yeah, because now you're able to go and borrow and lever.
Yes, that's correct. I leverage more. Yeah. I leverage more than when I would use the lower credit product.
So now with the change in rates that is likely to happen, and we have some macroeconomic pressures or levers that are at play here. One, we see that the central banks are pulling back in terms of investing, and then of course, as a result, the impact is going to be the money, the liquidity that was available is now going to become less available, and of course, the impact on rates are that they're likely to do what?
Go up.
They're going to go up
until something breaks.
Yeah, and the issue with that is if you look outside your window, if you're in any major city,
right,
you're probably going to see some construction.
That's correct.
Going on. Okay, and so for those lenders, and this is one of the reasons why we always talk about be very, very careful about who your financing partner is going to be when you're going into these construction projects, because sometimes a change in condition in the economy can highly impact you.
Yes.
For instance, if you are a bank, okay, and all of a sudden your liquidity is drying up, rates are going up, you got a lot of risk out in these construction deals. Now you're worried. There's a chance they may decide not to fund that next draw.
That's exactly correct. They may not follow through to completion.
And now if you're a developer, you have a real problem, right? And so sometimes that private source of capital, because they've already committed to getting that money out to you, because they have to create a yield on the investments they've made to their savers, right? And so sometimes you really, and that's why it's so important to really understand the secondary market.
It's very important.
Yeah.
And in fact, you're playing in the primary market. It's very important that you understand, where does your lender get his money?
Right.
Always understand, where does the dollar bill come from? So as I said, at Dynex, it comes from the savers. How do we get their dollars? They purchase our stock, or they purchase our preferred stock. And then when we buy the assets, we then will borrow more money. So you may have a lender making a construction loan. Is it JP Morgan Chase? That's one entity. Or is it a small debt fund? Those are two very different entities. And if I were you as a borrower, I would make sure I understood the financing sources behind that lender, especially if you're dependent on them to make for additional draws and to close that loan out.
Right.
Because you may find yourself caught where they can't do it if it's the wrong entity that's not strong enough.
So are you telling me that my decision to choose a lender over one lender it isn't just the interest rate?
Yeah, it's definitively not just the interest. And I know a lot of people will make that type of decision. Right. Can I tell a story? In March 2020, it was unbelievable. March 2020, the financial system, as far as I am concerned, this is Byron Boss, it was going down.
Right.
And the reason, there were a ton, there was a ton of people who found themselves in liquidity problems.
Right.
And it was absolutely a snowball effect that was taking place. And what shocked me is how many lenders outside of the big money center banks, the money center banks were fine. And you hear the Fed governors, they'll say, oh, well, the banking system was fine. Yeah, maybe not. That's like looking in the medieval times and say everybody inside the castle was fine. Where everyone outside of the castle, where happened to be a ton of lenders who were not money center banks, were having a problem.
Right.
They were having a problem because their source of liquidity and the credit quality of the loans and securities they were lending against were questionable at the time. So we had a problem as a country in terms of the financial system. So it was amazing to me. We were fine at Dynex. We carried a ton of liquidity. As I mentioned to you, we had gone up in credit, up in liquidity. And dealing with other lenders and looking at their balance sheets, gosh, I couldn't believe the risk that they were taking.
Right.
So if you are in the primary market, you are a developer and you are developing a project where you are involved with a lender and you're depending on that lender for multiple draws and maybe even closing that loan out at the end, I would be very careful. I would assess what's the credit strength of that lender. It goes both ways because I borrow money on repo and now we have to do a credit assessment of our counterparties from whom we borrow money. We know we're fine. Where JP Morgan is my favorite counterparty, they're going to be fine.
Right.
But when I venture beyond the money center banks, we at Dynex Capital have to be careful from whom we are borrowing to ensure we understand their situation.
Right.
And I can give you more stories. I can give you another one with MF Global. That was an entity that was lending money to us maybe a decade ago. And we wisely, I'll give you two. We wisely pulled our money from Lehman Brothers and MF Global before they went down.
Wow. Now you could see the writing on the wall.
Well, we're trying to do some type of credit work. Obviously, there's news stories that start to come out where there are some issues or there are some problems.
With their security.
And so because we were alert and understood that you can't just trust your lender. Your lender can, in fact, go under.
Right.
And if they go under, and for us, we would have put up some of our own capital as margin against our borrowing, then that's a problem for us because that means some of my capital is tied up with a bankrupt lender. So
yeah, well, I'll tell you what, and there's so much to know. We just thinking about the secondary market and all the things that have to be considered and evaluated on that side, and then how it impacts the primary market. So now we're in this stage where we have just talked about the government starting to pull back a little bit. Interest rates are going up a little bit. What do you see over the next 12 months? What do you see happening in the financial markets from a macro perspective over the next 12 months?
So the number one thing that we have talked about has been surprises are highly probable. And we've been saying this for years, before the pandemic. And about 2014, 15, we started to say we're concerned with the complexity of global risk. And that's when we sold our BBB securities. We sold our single A rated securities, double A rated securities, unrated securities. Our illiquid agency back, we had an an adjustable rate mortgage portfolio backed by Freddie and Fannie, but those were less liquid securities than owning a 30-year mortgage backed by Freddie and Fannie. We sold that entire portfolio. So we adjusted the entire portfolio. We went up in credit, up in liquidity, and we started to carry probably 5 or 6 times as much cash on the balance sheet. That's because we felt global risk was more complicated. So now roll forward to where we stand today. We come into 2020. We have a massive crisis. We're prepared because we've already been concerned about global risk. We started to say surprises are highly probable, meaning we're not predicting exactly what's going to take place, but we believe there's enough probability attached to potential what people would call tail events, such that we're probably going to get surprised. What are some of the other underlying destabilizing factors? Huge amounts of global debt. There was huge amount of global debt before the pandemic. Now there's a ginormous, if we use that word, amount of global debt after the pandemic. That's a destabilizing force, right? You really need, I always laughed that you'd hear Jerome Powell, some others say, well, debt service coverage is really low. And I said, sure, as long as interest rates are low.
Right.
Well, what happens when interest rates start to rise on a huge bed of global debt.
Yeah.
Another destabilizing factor, in our opinion at Dynex, global asset prices are high. Well, what asset prices? Stocks, Bitcoin, cryptocurrency, antique cars, baseball cards, you name it, houses, you name it, an enormous amount.
Liquidity in the market.
There's so much liquidity in the market.
Right.
So we're concerned about the potential for correction in global asset prices. And then we're saying asset prices. Obviously, the best poster child for that happens to be the stock market. So if you look at a chart, you can look at the size of the Fed's balance sheet, and then you layer on that the S&P 500. They both go straight up together.
They correspond.
They easily go up together. So that we believe that type of correction is a concern. So the way I would say it is global asset prices are high, and they sit on two rickety pillars. One is an enormous amount of global debt, and number two are large central bank balance sheets, where central bankers are now trying to figure out how do they reduce their balance sheets. So other destabilizing factors that are kind of way below the surface, maybe below the surface. We believe human conflict has risen across the globe for numerous reasons. And in history, if you look back, those have really been surprise events. Anything from a 19-year-old shooting the official from Austria and causing World War I, to the rise of a Hitler. But human conflict is always a surprise. To 9/11, that's a classic example, right? No, September 10th, 2001, beautiful day. By September 12th, the world had changed, right? And a human conflict with someone flying a plane into the World Trade Center. So we're concerned about a human conflict. Technology is changing the world. Technology is actually fueling human conflict, correct? And it's also allowing capital to flow freely across borders. So I have to be concerned with what's happening globally. You could say Dynex Capital's based out of Richmond, Virginia, a real estate investment trust who's generally lending money against U.S. assets. So why would you be concerned with what's happening outside the United States border? Because everything now is global. Capital moves across borders. What happens in Europe, what happens in Japan, what happens in China can easily impact what happens in the United States. So I hate to say this to some homeowners, you should understand. I know you have a lot of profits in your home.
Time to sell.
But
They better sell it.
Oh, God.
But, prices are going up. It's really going to be interesting because I've been tracking this for a while, too, especially with regards to construction projects.
Right.
There are a lot of major construction, and there's a lot of demand for these multifamily assets and assets that support living in general. But, we've had a lot of capital to fund that since 2012.
Yes.
But we are getting to the end of that cycle. The liquidity is going to start pulling back. Rates are going to start going up. In some ways, if you're highly liquid now, there's going to be some pretty good opportunities for you in terms of picking up discounted assets. But if you're in the middle of these projects, you might want to start paying attention and making sure you're hedging your bet. If you're with a lender, you need to start talking to them and talk about what their plan A, B, C, and D strategy is to address some of these changing events. If you're not doing that, you might be kind of headed for trouble. Now, I do want to ask you one question. We didn't talk about this earlier, but in our conversation, I think it's very important. What impact do you think cryptocurrency is going to have on your business?
We're not sure yet. We're not sure. Blockchain technology is where I would start that conversation.
Okay.
And it's evolving. It's one of the factors that are evolving. When I say surprises are highly probable, it is one of the factors that are evolving right now. We're not 100% certain. What we are doing at Dynex, because we're respectful of the fact that technology is going to change or continue to change the asset management business, we're making major investments in switches and changes in how we do things. People, process, and technology. We're trying to partner with a larger technology provider, probably the best in the industry. I won't mention the name right now because we are not completed with the project, because we're respectful of the question you asked. And it's not only blockchain technology; it's other data. It's data manipulation. It is simply
security.
Securitization. So we understand that. We believe technology will continue to change the asset management world. We're not large enough to make these individual technology investments ourselves, and so our best strategy is to partner with the right players on the other side, larger players, build the right relationships. We already had one. We're going deeper into that relationship to put us in better shape, give us a little bit of the higher probability we'll have a competitive edge as this world continues to change.
Right. So the current financial system is heavily influenced by government, how they manipulate the monetary system.
Yes.
Cryptocurrency proposes to kind of strip that power away and shift it to a more, I guess the goal is to shift it to a more stable currency, to where you don't have the major world powers controlling certain currencies that can control and manipulate the world market. Okay, as things move more towards crypto, that power now becomes, it's more diverse. The people who hold all the crypto. That's why probably you see some of these major corporations trading and buying and absorbing a lot of crypto because they recognize that, in my mind, that they recognize that the folks who have the most cryptocurrencies can now start manipulating the prices in cryptocurrency. And if it's seen more as a tradable asset than the dollar bill, then that gives them enormous power and control. And I just wonder how, other players who deal in dollars.
Yep.
Okay, because that's what you
that's
do.
What we
you
deal
in dollars.
That's exactly correct.
But as this economy proposes to shift towards away from dollars, okay, to more of this blockchain technology, cryptocurrency model, how might that impact you?
So the one speed bump. The governments are still very powerful. Everything about what we're doing now is government. What we say at Dynex is government policy will drive returns.
Okay.
So that's on the front of what the central bankers do. It's clearly we've seen enormous fiscal policy that's had an impact, and then the next leg are the regulators.
See, that was my next question.
It's the regulators.
Yeah, because now you're starting to hear that.
That's exactly correct.
You're starting to hear Congress talking about, well, we need to regulate cryptocurrency.
That's exactly correct.
Which is code for we need to take control.
That's exactly right.
Of cryptocurrency because they could lose their power.
Yeah.
If someone else controls their currency, right? And if you study history and you study these world powers that have come up, a lot of they take power and control using force, war. But the second most common way of doing it is through money.
Right.
You drive a company into debt and then force them to use your capital. You now control them.
Yep.
Now, if you strip the power of your capital away and you come up with another worldwide currency that is as valuable, that becomes a problem for a sovereign government, right?
And that's why I point out the regulators. So government policy will drive returns. We've got central bankers, we've got fiscal policy makers, and we've got regulators.
Right.
And the regulators are not minute by any stretch of the imagination. So what's fascinating, that is evolving.
Right.
So when I say surprises are highly probable, again, and we said
live in phenomenal times.
Phenomenal.
Man, I tell you, there are things that are happening today that are just absolutely amazing if you open your eyes.
That's exactly correct. And there are some great things, and then there's some ugly things that are. That's why I point out the human conflict.
Right.
And for us, this is a very Byron opinion. And if high blood pressure is the silent killer in a human body, I am concerned about the human conflict and which a lot of it will in some way be indirectly driven, come from wealth and income inequality globally. Can be the silent killer in our global economy. Yeah. So I don't have any predictions on this. It is a risk factor that I'm concerned when I look at history.
Yep.
And I pointed out World War I, World War II, 9/11. There are plenty of other examples where human conflict creates a surprise.
Absolutely.
So at Dynex Capital, what we want to be prepared for, if there is a surprise, we can't freeze.
Right.
we have to make the right decisions at that time for our shareholders. Right. And that's why I like to start the conversation. Who's the number one person that we're thinking about? Not only our employees, but also the savers, because it's their money that we've taken. So we can't freeze at these big moments in history. I believe we're at a moment, just like you said,
right.
Phenomenal moment in history.
Right.
Surprises are highly probable because there are real changes that are taking place. They're complex, they're interconnected in ways that I don't know any of us really fully understand. And I accept the conclusion that this is an evolving environment. Why do I get excited about Dynex Capital? We've had enough sense to be liquid, to go up in credit and up in liquidity. That puts us in very good position
right.
to adjust ourselves and make money in any environment. So, and we do have, a lot of times people think about the history and they say, Fed raises rates, and they'll think back. I remember the S&Ls from the 1980s. That's archaic. We have tons of tools that we can use to manage the risk on our balance sheet, whether rates are going up or rates are coming down.
Oh, fantastic. Mr. Byron Boston, thank you so much for being on our show. Check out his stock symbol, DX. You can see the man, how he's managing his portfolio. Sounds good to me. So check those guys out. They're doing a great job of looking at what's happening in the environment and making the right decisions for their investors. Thank you so much for helping us understand the difference between the secondary market and primary market and how they interact. Excellent podcast show. We'd love to have you back on our show at some point.
Sure, I would love to. Thank you so much.
All right,
it's a great opportunity, great conversation. Thank you.
All right. Don't forget to like and share and subscribe. Please do that. That helps our show, and that allows us to bring you phenomenal content. Until next time, we look forward to seeing you again on the Capital Playbook.